Welcome to the Explainer. So today we're doing a highly focused, absolutely crucial deep dive into the very core of bank analysis. We're actually pulling this straight from a professional checklist used for analyzing listed banks, and we're zoning in entirely on step one, the spread engine. Look, if you really want to understand how a bank makes its money, you literally cannot skip this step. Let's just dive right in. Right off the bat, this is the fundamental primary question we've got to answer before we even think about looking at the rest of a bank's financials. I mean, before we dig into bad loans, way before operating costs, and long before we argue about valuations, we have to ask, is the lending engine healthy and growing? Because honestly, if the core business of lending money isn't working, absolutely nothing else on the balance sheet is going to save it. So we're isolating step one, check the core earnings. This means we are looking strictly at NII and NIM. The professional checklist demands that you always begin with a spread. Why? Because this is the core business. We're going to isolate exactly how that core business generates its profit, which, by the way, is the best way to stop yourself from being fooled by flattering headline numbers. Okay, here is our roadmap for mastering this engine today. 1. The bank's spread engine. 2. Unpacking net interest income. 3. Why the margin matters most. 4. Tracking shifts and trends. 5. Surviving falling interest rates. And 6. Judging the core engine. Step by step, no distractions. Let's go.
Number 1. The bank's spread engine, the core business of lending. Think of a bank kind of like a giant manufacturing machine, right? The raw material it uses? Money. So, on the liability side, the bank takes in deposits from you and me, and, well, it has to pay for them. That's the cost of funds. Then, on the asset side, it pumps that same money out as loans earning interest. That is the yield on advances. The difference between what it pays out and what it takes in? That's the spread. It is literally the heartbeat of banking. Moving on to 2, unpacking net interest income, the actual rupee profit. So net interest income, or NII for short, is the pure hard cash generated from that spread. It's the actual rupee profit a bank is making strictly from lending. When you're analyzing a bank, you always want to check the NII, but crucially, you want to check its year-on-year growth. You have to ask, is the engine producing more pure lending profit this year than it did last year? Because if it isn't, well, the engine might just be stalling out. Part 3, why the margin matters most, normalizing for size. Picture this. Let's say you open an earnings report and you see this massive profit number, like, say, 10 billion rupees. At first glance, a headline like that screams, record profits, right? But a professional analyst doesn't stop there. Why? Because 10 billion rupees means something entirely different for a massive, sprawling global bank than it does for a tiny local regional lender. The raw numbers alone just don't tell you how efficient the engine actually is. And that is exactly where we must use the net interest margin, or NIM. The NIM is the ultimate truth teller here, because it grounds that giant, flashy figure back into reality. It normalizes the profit for the exact size of the bank. By looking at the NIM, you're getting a percentage that measures the core lending profit relative to the bank's total earning assets. This is the magic number that allows you to truly compare efficiency against peers of completely different sizes. Like our source material points out, a 3% margin might be perfectly healthy for a giant public sector bank. But man, that same 3% would be deeply alarming for a small finance bank, where you'd probably expect something closer to 6 to 9%. The NIM gives you that vital context. Okay, part 4, tracking shifts and trends. The 4-quarter view. You've got to meticulously track the direction of the margin over the last several quarters. You want to be asking, is the margin expanding, is it holding steady, or is it compressing? For example, if a bank's margin was 4% at the start of the year, but it's slowly ticked down to 3.5% by Q4, well, that engine is losing efficiency, and you definitely need to know exactly why.
So, to run this diagnostic properly, our source checklist demands you pull these exact, specific metrics from the filings. First, grab the net interest income and its year-on-year growth. Second, get the net interest margin and its 4-quarter trend. And finally, to really understand the why behind those numbers, you absolutely need the yield on advances and the cost of funds. Getting this specific data paints an unambiguous picture of the engine's health.
Once you've got those numbers in front of you, you basically become a detective. If the margin is moving, why is it moving? Is it because of the asset side, meaning what the bank charges for its loans is changing? Or is it because of the liability side, meaning what the bank actually pays for its deposits is shifting? Diagnosing exactly which side of the machine is causing that change is totally key.
Number 5. Surviving falling interest rates, stress testing the engine.
Let's walk through this scenario carefully. When central banks cut rates, loans usually reprice downward very, very fast. Their yield drops almost immediately. But deposit costs, the money the bank pays out to us, well, they tend to fall much more slowly. And because the money coming in shrinks faster than the money going out, margins inevitably compress. This right here is the ultimate classic stress test for a bank's spread engine. Which brings us to a massive golden rule straight from our source material. If a bank can manage to grow its net interest income faster than its peers while simultaneously holding its margins steady in a tough rate-cutting environment, wow. Take note, you have found a genuinely powerful franchise. Their engine is so robust that they can navigate real economic headwinds without sacrificing a single drop of efficiency. Finally, Section 6. Judging the core engine, the final verdict.
The source document lays it out perfectly here. The ultimate output of this entire first step of analysis isn't just a boring spreadsheet full of numbers. It's a clear, unambiguous judgment call. You have to make the decision. Is the core lending engine strong? Is it steady? Or is it weakening?
So next time you look at a bank, ignore those noisy, flashy headlines. Pull the filings, look squarely at the NII and NIM, check that 4-quarter trend, and ask yourself, is this bank's engine roaring ahead, or is it quietly stalling out right under the hood? Getting step 1 right is literally the foundation for everything else. So take a look at the bank you're currently invested in. Do you actually know how efficient its engine is today? Thanks for joining me on this explainer. Catch you next time.